Kalimera Salus, Kai Kalos Irtates, O Economica Kalimera Anthropos. Welcome everybody to O Economica, all about economics and finance. Very glad to be with you all today. That's my new content. Very interesting content with plenty of data. I have modeled. I have a lot of work with data, with the most crowded and known ETFs for retail investments. There will be, you can have a glance here, there will be S&P 500, TLT, GLD for Gold, QQQ, and also I have uploaded also I've worked with the time series of all the United States economic sectors, like XLE, XLF, all most known ETFs in the market, and I will show you some very interesting results, and I have included also gold because like many other people, I've been puzzled by this huge rally in gold prices, and we've seen the latest upgrades from large investment banks. They are upgrading gold prices to a target of $4,000, even $4,600. Very interesting times. And I have to specify that the content in this video, that it does not constitute financial advice. This is only for educational purposes. For any decision, you do your own research and consult always your investment bank financial advisors. I'm not suggesting anything about any sorts of investment. This is only educational content where I share with you my work with time series analysis, and I share with you my findings for when it comes to macroeconomic research or financial asset research, etc. So we can start, and we are staring at this chart, cumulative returns of major ETFs, and immediately we see that the QQQ ETFs is the most performing in terms of cumulative returns, and the worst performing it has been TLT, which is the ETF that tracks the treasury bond market, the treasury yield curve. It's, I think, most of the debt securities are very long duration treasuries, like 20 plus years or 10 plus years or stuff like that. And in a rising interest rate cycle, we saw that we have a lot of underperformance from bonds, and we have seen a lot of overperformance, like abnormal returns from in QQQ, in S&P 500 or the Vanguard total market. And also we have gold. Gold has been catching up with a lot of high volatility. It has been breaking out level after level, 3,000, 3,500, 3,700, going for 4,000. We don't know where gold will stop. And as I was saying, my first impression or idea is that is it gold an edge of inflation, or is it just investors allocating into gold willy-nilly? Is it central banks? And I have also tried to understand if it's gold, it's a sort of hedge for low liquidity markets. So in a sense that investors, they are piling into gold because they can see that there is a long rally. Equities they are very expensive. Investors, they are skewed towards very risky equity allocation, and in case of a sharp short shock and drawdown in the market, gold can be an edge against market liquidity distress. So in a low liquidity environment, gold tends to be a protective, a defensive asset to have, and eventually it can provide also positive returns. So that's why I've tried to find out as most parameters as possible, as many parameters as possible. So here we have the conditional volatility, and we can skip on this because we don't need it for the minute. We can see here we have a very nice chart, 63 days rolling correlation with the S&P 500 for only 5 assets, and we can see here that the most correlated, of course, are the QQQ and XLK, which are pretty much the same. One is the tech sector ETF, QQQ is the Nasdaq, and we have the green line, it's XLE, it's gold. and we can see immediately that gold, it's pretty much not correlated with TLT in the previous period from, let's say, 2016 up to 2020, but also going forward. It has a similar structure or pattern to bonds, but then the correlation is not really much significant. It doesn't have a very significant correlation coefficient. What we can see now, in fact, is that gold prices or gold daily returns, they are negatively correlated with the stock market, vis-a-vis the fact that gold is going higher together with equities, but the negative correlation coefficient informs us that eventually, when we have a correction in stocks, in equities, and also in ETFs, eventually gold will be less affected by a stock market drawdown, withstanding a negative correlation coefficient. So market goes down, gold is inversely correlated. Eventually it would go up. It would even appreciate even further. So it can be an edge or a protection against the market sell-off, and eventually provide positive returns. I have to specify, I'm not sponsoring any gold company or anything. I'm just telling you that we have an inverse correlation between the S&P and gold. So eventually, when the S&P sells off, gold would be a long, or eventually it would protect you against the market drawdown. And here, this TLT line is eventually it's near neutral level, like zero, no correlation with the market. And what will make vary this correlation coefficient eventually is the changes in Fed funds rate. So if Fed funds rate start to decrease, eventually we will have a lift up in bond prices, more flows of funds into bonds, ETFs, although the federal funds rate, we don't know what is the terminal rate. It's very difficult because there are so many macroeconomic factors. It can be inflation, geopolitical risk, tariffs, supply chain. So we have sticky inflation, slowing economy, and so it's difficult to price in a lot of interest rate cuts, and that's the bond price upside. It's limited to the extent of how many or how much the Federal Reserve will decide to decrease the Fed fund rate. So all in all, gold is inversely correlated with the S&P 500 ETF. So gold is going up, the market is going up. If the market goes down, gold should be a good edge against market sell-offs. Another very interesting chart, we have a CAPM regression. So we see here, for example, that we have the alpha, the excess return, portfolio excess return, or the asset excess return vis-a-vis the beta exposure, beta market exposure. And we see here that gold, it's up here. It provides the higher alpha, like 4% return, and the beta is almost neutral to market volatility, which is very important because we have QQQ here, the NASDAQ or the tech ETF, which have a very high beta, so they are very sensitive to the market. They move to the upside, to the downside, in excess of what the market does. In this case, is the S&P 500 ETFs, and the alpha generated, it's around 1%. So what it means that gold provides high returns with the neutral beta. So there is no volatility vis-a-vis the market, and it's way better than, in this case, for when we run a linear regression on a CAPM model, we see that gold performs better than the NASDAQ or the tech ETFs. Markowitz efficient frontier portfolio, we want the maximum Sharpe ratio, so we want a higher annualized tangency portfolio, the best annual return vis-a-vis the most contained annualized volatility, so the optimal ratio between annualized returns and annualized volatility. We see that the top is the XLK, the tech sector ETF, 20% annualized return, but we are around 24% annualized vol. So we see here that gold, for example, again, we are close to around 12% annualized return and 15% annualized vol. What the Markowitz efficient frontier shows us is not only the tangency portfolio that we will see also in other charts, but basically that annualized returns in portfolio allocation, annualized returns, they match quite often what is the annualized volatility. Most often than never, annualized volatility is always a little bit higher than annualized return. There is a little bit more risk than reward. That then depends on what kind of portfolio construction, a theoretical portfolio construction you can make, what is CAPM, tangency portfolio, equal weighted risk parity, if just ETFs, there is a lot to consider. And in fact, we see here we have two kinds of portfolio, which shows us what is an equal weight portfolio, what is a risk parity portfolio. And in this case, the equal weighted portfolio provides a slightly higher annualized returns of 11.5%, but the annual volatility is 14%. The risk parity portfolio is 10% annualized return, 12% annualized vol. The assets considered are the 6 ETFs. And for the risk parity portfolio, we can see here how automatically on the basis of the considering the standard deviation parameter, there is a larger allocation toward gold and TLT, so the bond ETF, which has a lower standard deviation and provides positive returns more or less, though TLT is a bit atrocious, and a little less allocation here towards energy or XLK. There is a little bit less allocation compared to the equal weight portfolio. You can see here they all are equally weighted, 16.7%, the same slice of the pie. But when it comes to risk parity, we see that on the ratio between standard deviation and annualized return, so annualized volatility, annualized return, the risk parity portfolio allocation, the weights of risk parity portfolio, they change a lot. And gold, it has the largest component. So it means that in a risk parity portfolio, gold, it's a very large component. It provides the required rate of return vis-a-vis a very contained standard deviation, annualized vol, and a neutral beta. Here we see another thing, which is maximum drawdowns, and because of the interest rate hiking cycle, the TLTs, the bond ETFs, has been a long time in a very large drawdown, minus 40%, and also in Q4 2022 we see QQQ here, the Nasdaq ETF, a huge drawdown, and also another drawdown here, which is the Q1 2025. So when there is higher market volatility, these ETFs, which are exposed to Nasdaq stock, tech stocks, growth stocks, they are very volatile, they can have very large drawdowns. And to hedge an ETF is not easy, because, I don't know, you need to have an inverse ETF, inverse leverage ETF. It's very, very complicated. So what sticks out to me, what jumps to the eye is that basically the TLT bond ETF, long duration bond ETF, it has been negatively in the red, minus 40% for a good 3 years now, for almost 4 years. And with the Federal Reserve decreasing interest rate, there will be, as I said, a gradual flow of funds towards bonds, although the problem are long duration bonds. They don't see a bid, like not even if any kind of miracle would happen. So that's also important to see. We can just check it here. I have here a page of we see here TLT aggregate bonds, all bonds, corporates, RQD, ETF corporate bonds, high yield bonds, and IEF. It's it's the iShare for the treasuries with a duration between 7 and 10 years in aggregate. And if we want to visualize the 1 year return, we see TLT is down years, minus 10% in the past 1 year. It has performed positively, slightly positive, it's high yield. And naturally, high yield, it has a positive 1.6% return, because high yield market provides higher interest rate, higher risk, but vis-a-vis the sticky inflation in the past, inflationary shock, it's it's the risky investments that funds then give to retail investors. They take a choice to take these kind of risky bets on a high yield. Although these are bonds, so they are more they're supposed to be safer than equities. But year to date, what is performing better, it's LQD, so it's the investment grade corporate debt. It's up 5% ETF together with the iShares 7 to 10 year treasury bonds. So the IEF, these two, we see year to date they are providing a 5% return, and which is not annualized. And then in positive territories we have aggregate and all bonds. TLT, it's a meager 3%, and high yield is the worst performing year to date. If we expand on a 5-year horizon, we see TLT is minus 45%. It's all bonds ETF, they are all deep in the red. They are in a long drawdown period, and eventually for technical market fund flows and flow of funds, and also for how what happens generally speaking is that assets that are underperformed and they have a long momentum of underperformance, of drawdown, they should converge towards the mean, to the average yearly return that the asset provides or what the market requires. So eventually this long period of drawdown in bonds should turn around and start to produce positive returns, as we see in the year to date. The opposite will happen for the assets that have overperformed. They've generated very large abnormal returns, and so those they will revert to the mean, so they will decline. So eventually there should be a balancing act in the market for flow of funds into bonds coming out from equities or stock allocation, although that would not be a all-out, all-in bonds, because as I said, and everybody understands and knows better than me, we have sticky inflation, we have supply chain constraints, geopolitical risk, tariffs. So with sticky and high persistent inflation, it's very difficult to have a 10-year treasury at 2.5%. It will always be around 3.5, 4.5, and it depends if we have bond market volatility, or because at the minute the investment grade corporate bonds they are performing better than TLT, and that means that the long duration bonds they are a bit of a problem for bond funds and just the institutional investors, investment bank, hedge funds. Nobody likes to have exposure in long duration bonds, in long duration sovereign debt, because of the lack of fiscal disciplines and the persistent fiscal deficits and all the geopolitical risks, all the disasters that politicians makes. They can't have proper accounting of their fiscal budgets, and then they go into stupid arguments with other nations. So the political sphere, it's a disaster. And so what happens is that the sovereign debt pays the economical price of political class mismanagement, and they are a complete disaster. And it just this week, France has been downgraded, sovereign debt has been downgraded from AA to A+, AA minus to A+. So that speaks volumes of the past decade political class mismanagement. And now we are at the top of the disaster, also in geopolitical terms. So investing in long duration bonds, nobody in his right mind will do that, even if yields or coupons they are pretty interesting. So going back to our modeling, we see here that risk returns, top of the pop, it's QQQ, XLK, S&P 500, Vanguard total market, it's middle of the pack, and was performing TRT. Gold, a solid 12% annualized return, and almost 15% annualized volatility. So we have a longer table. We repeat the same exercise with a longer table, including all ETFs. We visualize the conditional volatility, the correlation matrices, and here we have again blue line, gold, inversely correlated to the market, and high yield bonds, this pink line, purple or pink line, it's positively correlated to the S&P 500 ETF. So bear in mind, when equities are selling off, it's very likely that high yield will be selling off. It's the most sensitive, interest rate sensitive part of the market, and the lower with the lowest quality, credit quality. So it's the first part that the in fixed income gets the hit of investors basically not allocating or selling off high yield bonds. Let's put it that way. So here, okay, average correlation, iShares, Vanguard, okay, those are the ETF issues, and okay, we have the same Markowitz efficient frontier. The only thing, instead of having TLT, we have HYG, so we have high yield, and we are around 9% analyzed volatility, and around, I don't know, 5%, as we have seen here, a bit more than 5% annualized return. And in an equal weight and risk parity portfolio, we have, because we have more assets, these are 7 financial assets that have been utilized for an equal weight portfolio. And here we see risk parity portfolio weights. We see exactly that what gets the most allocation. It's gold and HYG, high yield. On the previous example was TLT. So and we have 11.5% and a slightly lower analyzed volatility, but pretty much they are the same. And I think this can be pretty much decent portfolio construction, although they are pretty basic because they are going for the S&P and the QQQ. So it's pretty much ordinary stuff, not exotic stuff, which is good because these are very liquid ETFs. The VOO is nothing else than the Vanguard replication of the S&P 500 in the form of an ETF. The IVV still is the S&P 500, but it's iShare. So the equal weight portfolio is not really equally weighted, because if we replicate the S&P 500 3 times, there will be 42.9% allocation towards the S&P 500. Yeah, so it's not really equally weighted, and it's not really diversified. The Nasdaq would get 14.3% high yield gold, and VTI is the Vanguard total stock market. So it's also it's core US equities. So in reality, there is not much diversification in the equal weight portfolio, because SPY, IVV, VOO, there are 3 different providers for tracking the S&P 500. So it's the same underlying financial asset. And at this point, probably the risk parity portfolio will be a better choice. I don't know, probably not, because the financial instruments are all the same. So we would have to structure the portfolio in a different manner. Here we see, for example, that what provides the past performances, what provides the better analyzed return are XLK and QQQ. So these start to explain us what is the investors' behavior in the past decade. For example, there's a lot of exposure or allocation towards tech stocks, large cap tech stocks, growth companies, and we can visualize it here in the first 3 strings of the table. XLK is tech sector, QQQ is the Nasdaq, and IWF is the iShare Russell 1000 growth ETF. So these are small cap growth ETFs, and those are the have been the top 3 in this instance, the top 3 ETFs among the ETFs that I have analyzed. Is by no means comparing to the whole ETF market. No, I have just 37 ETFs. No, probably 35 ETFs and 2 gold time series. So among 35 ETFs, the most liquid, the most known, what stands out in annualized return are again XRK, QQQ, and IWF. So we have tech sector and small cap growth sector. Now we can see how exactly also in the Fama French website database we can see the investors' behavior in the past 12 months. And exactly here we see small growth, okay, size and book to market portfolio, okay. So small cap growth in terms of book to market portfolio. They've been the most outperforming, 6.47% in the month of June, which is above the market risk premium. and in the past 3 months, almost 12%, past 12 months, 14%. So investors' behavior, it has been skewed towards small cap growth company, which are a very risky bet, because this is also on the wave of AI, these new companies with AI bubble, new companies with no revenues and or very little revenues, and they have a lot of expenses, and so there is a willingness to invest even from private investor, private venture funds into this new AI trend, artificial intelligence trend, and so that lifts all the boats of small cap growth towards an outperformance in the market vis-a-vis the what are small cap value company or neutral. They don't perform as much as growth companies. The same is for big large cap growth, okay, and they have big so large cap growth, they have underperformed small cap growth, so the investor behavior is very, very risky. Yeah, they're probably going for some sort of very risky bets, and in fact what outperforms large cap growth is large cap value, okay, 24% in the past 12 months, which is very large returns. These are not single stocks, but these are portfolios, yeah, Pharma French research portfolios, so it's an allocation to a wider sets of assets, and we have the different large cap conservative or aggressive. These are the different kinds of allocation, but here we can see how, for example, the idea of investors' behavior allocating towards large cap, it's also here small minus big. So the small are have underperformed, minus 8.6% in the past 12 months. In the month of June, there has been a neutral dollar allocation of $1 into small cap, $1 into I would say 98 cents into small cap, and $1 into large cap, so that we have almost a neutral portfolio allocation between small and big companies, and that explains us the rotation in market from large cap companies, and more funds are flowing into small cap or growth companies. And that's also a data point that confirms why the IWF, which is the iShare Russell 1000 growth, the analyzed return, it's 16.5%, and it has a very good Sharpe ratio, 0.79. So that's interesting. And as I was saying, it explains part of investors' behavior, which has been investors' behavior in these past years towards tech company and growth companies, even willing to, I don't know, bet on Rivian, which is a small cap growth company, which takes many years to turn a profit. So we have here market liquidity. We try to track market liquidity with the bond ETFs or the S&P 500, and we see that vis-a-vis the levels of liquidity or the proxy levels of liquidity in the market, gold has rallied, but we can also observe that the correlation vis-a-vis what is the proxy of measure of liquidity for gold, it's inversely correlated. So we could extrapolate the data point that gold could rally also in the case of lower liquidity markets on distress in stock market, basically. And here we have the linear regression equation, y equals the alpha parameter and the beta parameters, and we see how we have four quadrants, let's put it this way, and we have here on the top left quadrant we have positive gold returns vis-a-vis negative market liquidity, although we have also negative gold daily returns in periods of market distress, because when there is a liquidity crunch and you have gold, you need cash, you have a margin call, you will sell also gold, yeah, because you sell treasuries, or if you need liquidity, or you will start to sell stocks, and then eventually you can sell gold. That's a liquid asset, sort of a liquid assets. So, but anyway, what we can observe is that gold provides positive return vis-a-vis shrinking market liquidity, and that can be confirmed by an inverse or a negative correlation coefficient. And what gives us the measure of how gold can diversify and hedge against stress periods in the market is here. So during normal periods, we see the green line that you can have an average return of 5.7%, while instead during periods of distress in market, the being allocated in gold, like gold spot price or gold futures or gold ETF, still provide a positive return of more than 1.2% according to the past few years performance. So we see when in period of market distress, it was 2022 or Q4 2024, Q1 2025 or 2020, and the market goes down, gold can be a refuge, a protective asset against liquidity distress. And something very interesting that in the past 1,253 days, trading days, which is 252 days for a trading year, gold has outperformed the S&P 500 ETFs by 50% of the times. So it seems that now I'm promoting gold, I'm just sharing with you what are my findings, is that basically S&P daily returns and gold, they are not pretty much the same, but gold can outperform the S&P 50% of the time. So it's theoretically, it's a very good asset to have in a portfolio allocation. And yeah, okay, so we have other charts. What are the average daily returns in stress periods? 1%, in normal periods 5.7%. Daily volatility, it depends when there is market distress or normal times. And sort of measure what have been gold returns in the past 6 months vis-a-vis liquidity changes in market. And going forward, we have more informative data about the 35 ETFs plus 2 golds time series. And we see what is the correlation coefficient for all the ETFs considered, and the TLT and the iShare ETF, which are treasury bonds ETFs, they are inversely correlated to the S&P 500. We can have a measure of what is the annualized, because I have also I should have the Excel file. Okay, okay, no problem. We can just jump in the ETFs file 1 second. Probably is this one. Yeah, sort of, some sort of this kind of thing. Okay. So we can see the annualized return, the annualized volatility, which are pretty much similar, the Sharpe ratio, and the VAR 95, the conditional VAR 95, and the correlation coefficient. So ETF detailed analysis report. This is ETF analysis result. Okay. Do we want to update the thing? Okay, let's find it. Bear with me, chums. Yeah, okay, got it. It's one of the many things that you can see. I have a series of Excel sheets. You can eventually, okay, because here we include some statistical measures, which are skewness and kurtosis. And okay, if the time series are stationary or stuff like that. So we have 20 years of data, and we can compare, as I say, the annualized return, the annualized Sharpe ratio, the skewness, the kurtosis, excess kurtosis, okay, the conditional 195, are the time series stationary? Yeah, it's true. Okay. Yeah, so we can see here from the table that the IVV or IW, which is the iShare S&P 500 or the iShare Russell 1000 growth, they have north of 10% annualized return. QQQ 14.38%, the Schwab Global Market 10.5%, the S&P 500 10.3%, XLK 14.2%. That's the annualized return on average for a time series of data of about 20 years. You can see 5,026 observation. yeah, that's the annualized return. While we can see here that, for example, AGG aggregate bonds on all bonds ETFs, they have very little annualized return, which they don't basically cover for the market risk premium or the inflation. So that's very useful to have. And we can see what is also the skewness of these financial assets. Most of them, all of them, the skewness is negative. So tendentially, returns are slightly skewed to the negative side, and they are all they have all fat tails, because the kurtosis parameter is larger than 3, and yeah, VaR 95. It's yeah, it depends. Like bonds ETF, they have a very small VaR 95, which is minus 0 point something %, while instead, if we're going to consider this one or this one, which have higher returns, they carry a larger drawdown risk of the VaR 95. It's minus 1.8%, minus 0.98%, but it underestimates basically the expected shortfall, which can be as large as minus 3% of drawdown in one day for the ETF. And the ETF is not easy to hedge. The downside risk in an ETF is not really easy to hedge. And let's see, QQQ also, it's minus 3.36%. It's a very large downside risk. And in fact, it's almost 22% annualized volatility. So that's the risk reward conditionality to investing into these sorts of financial assets. And ETFs, or on the contrary, ETFs, they are not easy to hedge. Because these are not stocks or bonds where you can use a derivative contract, so you can build an option strategy and basically hedge for downside risk. I'm not an expert. There are inverse leverage ETFs, but it depends if those instruments, they are liquid or not liquid, and they don't give you any protection from a one-day stock market drawdown. And okay, we have a very clear summary of things. So the ETF with the highest Sharpe ratio is the Vanguard version of the S&P 500 ETF. The lowest Sharpe ratio is the Silver ETF. The average annual return is 7.4%. The average vol it's 18.4%. And as I said, the average skewness for all the instruments that I have analyzed is slightly negative. So we have more negative returns, daily returns, than positive, and we have fat tails, because kurtosis, it's larger than 3, and we have analyzed 36 ETFs, and the average daily drawdown is 1.7%. The average expected shortfall is 2.8%. So that is important, because the VaR numbers, they underestimate downside risk. Worst maximum drawdown, XLF, which is the financial sector ETF, minus 82%, which is huge. And yeah, of course, QQQ and XLK top of cumulative returns, but what offers the best Sharpe ratio, so the optimal tangency portfolio, is VOO, which is the Vanguard equivalent of the S&P 500 ETF. And we can go forward. We repeat the same modeling over and over again, and we don't have different results, so we can comfortably skip on this. So for my own study, I also went through an overlaying of the 21 days volatility moving average with the basically the chart, the price chart of the financial asset considered, and we have red dots when we have volatility spikes which are greater than 95th percentile of the average 21 days rolling vol. And we can see how the periods of drawdowns here and here, the blue line goes down, we have the red line going up, we have all these red dots when the volatility is spiking. So we have short period of very high market distress, liquidity distress, and so that's useful to see how in the immediate past periods, if we have some high volatility events, and if the moving average of the 21-day analyzed vol is trending up or down, it can give us a direction of what's to come, because the price of an ETF, in this case this is gold, GC, it's gold spot price, it tracks gold, it's By now, by today, what is the price of gold today? At the minute is $3,685. Okay, so we are here, and then we want to see how the rolling 21-day analyzed vol is behaving, if it's going down or up, because the underneath vol, moving average, it will tell us if eventually the rally is coming to an end, it's going towards a correction, because the underneath volatility, the underlying volatility in the asset, it's rising, or if we have crashing vol and then we can go long. So that's important. GLD, we have very subdued volatility and it's going higher. So also here HYG, very low vol and it's going higher. So there is money flowing into high yield. So that's the usefulness of overlaying the analyzed vol with the price action, the chart of the assets that you are considering. Okay, pretty much the same. With the analyzed vol, yeah, we have again the conditional volatility parameter that we have overlaid with the charts. The only thing that I can give you as useful is that the modeling that I've been running, they are updated to the 16th of September. So what you see here is the forecast, 10-day volatility forecast, which can be useful because the model is updated every day. And so I can forecast 10-day forward what tendentially is the conditional volatility that comes out from EGARCH model, which accounts also for the asymmetry of the conditional volatility shock. And we see that slightly bit higher conditional vol it's the model gives as a forecast. So probably by the end of September going into October we start to have some higher volatility. We'll see how investors will react to the Federal Reserve cutting interest rate. It can be a hawkish interest rate cut, and as I said in another video, it's decreasing interest rate vis-a-vis the same rate of return required for the market. It expands the market risk premia, and when the market risk premia expands, okay, so we have here, okay, 4.86 is the market risk premia. Now the Federal Reserve goes from 4.33 to 4, okay, so it does a quarter of a percentage point cut. So we can add back this to the market risk premia, and we see that RM, required market rate of return, minus the risk-free rate, okay, as we should measure the risk-free rate with the 10-year treasury yields, okay, we can use different parameters. I'm just giving you a broad concept, is that the market risk premia is not anymore 4.86, but it expands, it's 5%. So when we analyze the required rate of return of equity in a capital asset pricing model, and we have to discount for a larger market risk premia, that means the return of equity should be larger. And if we consider that stocks, they are very high valuation, they are very high, and the multiple expansion, it's already very high, because we have price to earning ratios which are 30, 40, 100. So I don't know how much space, sorry for my horrible grammar, how much more space there is to expand multiples vis-a-vis an expanding market risk premium. That's what I hope you can understand what I'm saying. If the market risk premium, so the risk of investing in the market, is not anymore 4.86, but it's 5.2%. So the required rate of return of equity, it has to be higher. And to have higher equity returns, it means that the multiple expansion, the price to earning ratio, it has to expand. So stocks have to go much higher than they are now, and it is very, very difficult to do. So what can materially, mechanically happen is that the Federal Reserve cuts interest rate, but you have a market sell-off, because we have an expansion in market risk premium. We want to absorb this expansion by balancing out the RM, the required rate of return of the market. Okay, so it's difficult. That's why we can link this concept to the conditional volatility forecast, which seems to be rising in the next 10 days, and maybe we can expect a market correction in October, or in October or in late November, which is possible. But by no means, what is the volatility regime now? We are at the bottom on the green line, which is a low volatility threshold. Okay, so the volatility regime where the most traded ETFs, which is the Nasdaq or the S&P or the Russell or the Vanguard, even gold, they are in a low volatility threshold environment. The market is going higher, and so we need a mean reversion of the trend and then a spike in volatility. And the Federal Reserve interest rate cut could be a catalyst either way. The market will continue to rally, or probably the market would sell off, because the market risk premium is too large. And then they need to compress equity multiples in order to assess basically which stock to sell, which stock you want to allocate your investment, so you have an outflow from abnormal or excess from abnormal returns towards underperforming assets, which is make complete sense of basically withdrawing liquidity, not withdrawing, selling off part of stocks which have run 20, 30, 40% and allocating part of that liquidity, taking profit from somewhere and allocating part of that liquidity in bonds, ETFs, or some stuff which has underperformed the market. So probably that's a component of what could happen. Now, if we consider the what are the top 20 most volatile assets based on the conditional volatility model, then we see that silver is the most volatile. So the silver ETF is the most, it has the largest conditional volatility parameter, 1.75, which is the sum of the alpha and the beta parameter, and somehow there is also the gamma parameter, the omega, blah, blah, blah. So and so we have silver, energy, XLE, financials, and VWO is the Vanguard FTSE Emerging Markets ETFs, which are the top 5 in this 20 league table. And surprisingly, silver, it carries a lot of conditional volatility. So it couldn't be a surprise to me if I see energy selling off, probably silver would be selling off, or if there is higher volatility in energy prices, then silver also could pick up that volatility correlation, and so you have high volatility in silver. Or if there is volatility in XLF, maybe there is correlated volatility in the silver ETFs. Same for emerging market. What it has the lowest conditional volatility parameter is GLD, again gold. XLU is utilities, or IVV, it's the iShare ETF tracking the S&P 500. So probably you would invest in the IVV rather than the Vanguard correspective of the S&P 500. Those are opinable choices. And then we can add more to the risk measures, to the risk managing or managing the risk in the portfolio when we go and measure, when we implement models that are useful to measure what is the value at risk in the portfolio, the expected shortfall, conditional volatility, extreme value theory. So when we have VAR 95, VAR 99, what is then the expected shortfall, those one-day big drawdowns in the market with very high volatility. And on the same line of the conditional volatility, we see that the the silver ETF, okay, it has the largest VAR 95 on an historical basis. So basically the silver ETF, it has an idiosyncratic risk which can be explained in the 5% probability to have a one-day loss of 3.05% or more, okay, because the conditional VAR 95 or the expected shortfall is 4.8%. So again, we see that the VAR parameters, they always tend to underestimate risk, because probably they don't account for the conditional volatility of the daily returns. And so this data is consistent with the silver ETF GARCH parameter, which is 1.75, so the highest conditional volatility. And same is for XLE or XLF. those ETFs, those sector of the economy, have very large, they have substantial VAR95, VAR99 model. Even the expected shortfall of VAR99, it's north of 8%, which would go above and beyond the circuit breaker. Nevertheless, to make the thing more dramatic is that basically when we have a conditional VAR99, conditional value at risk, so we have a bunch of ETF, we have a portfolio of 10 million, okay, and let's say, okay, I'll try to, let's say we have the first first 5, 1, 2, 3, 4, 5, okay, we have 10 million equally allocated in this SL first 5 ETFs here, okay, and so it's 2 million on XLK, 2 million on VWO, XLE, XLF, SLV, okay, so they are equally weighted, and we have a conditional VAR95, okay, so we have 3.46 plus 4.03. I'm doing this the simple way because I'm sure there will be more complicated methods to do this, and then 4.81, okay, let's do divided 5, okay, so the average conditional volatility of VAR95 is 4.3%. If we do 4.3% for 10 million, it means that no, sorry, 4.3%. So we have 10 million divided 4.3. No, okay. Okay, 10% of 10 million is 1 million, so $430,000. Sorry, I am crap in using a calculator. So the weighted average of these 5 ETFs here, VAR95, is 4.3%. So on a 10 million portfolio, we have a 5% probability that in one day the portfolio can experience a one-day drawdown of $430,000 in one day. Okay. Yes, that's exactly what it means a VAR95, but nevertheless, to make things more dramatic is that if on my portfolio of 10 million, it has an average of 4.3% VAR95, I know that there is a 5% probability that I can experience a lot, the portfolio will have to absorb a loss of $438,000, but it can be more than that. It does mean that the VAR95 is not a stop loss. So you have a parameter, but the loss can exceed way above that parameter, especially if it's accumulated in many days of drawdowns, in a long period of stock market distress and sell-off. So the VAR parameter is useful, but it's not the end of everything, because losses can exceed what are your value at risk parameters. So tendentially, the value at risk parameter always underestimate what is the true downside risk of a portfolio, investment portfolio, or the single financial asset. And in that sense, we could, for example, decide to have a equal weighted portfolio or a risk parity portfolio adjusted for VAR95 parameter. We can very easily take these parameters and we input those parameters in a modeling code for portfolio allocation. Say, okay, I want an equal weighted and a risk parity portfolio adjusted for the less risky VAR parameters. So in this case, we have the VU and the EFA have the lowest VAR95 parameter, and these are basically the VEU is the Vanguard FTSE All World excluding US, and the EFA it's the iShare developed market excluding US and Canada. So these two ETFs, they have something in common. They are invested in that part in all various assets in the market, but excluding US equities. So for that reason, probably they have a more conservative or less risky VAR95 parameter. And so you can build a portfolio asset allocation which is adjusted for the VAR parameters. And here we can see the different bars. what is most risky, yeah, SLV. Yeah, we see here the highest VAR 99 on an historical basis, and then we have the conditional volatility or the expected shortfall. So these are very interesting and useful parameters which are part of the risk management side of portfolio allocation or investments in general. And these the VAR parameters, they are part of the tools of having an asset allocation, monitoring the value at risk, the daily value at risk, or the half four report that investment banks have to provide every day for their funds, which is very, very, or their books, which is very, very large. Okay, I think I have the same iteration of VAR 95 for the whole 35 ETFs that I have considered here. And okay, I think we have also the Excel format of that, which is very, very interesting. Okay, I didn't upload the ETF, so let's stick with this. You can see it's a lot of data. It's a lot of data because there is the VAR 95, what is the mean daily return. We see here that the aggregate bonds, all bonds, they have a very moderate mean average daily return compared to gold. Spot price 4% daily return, GLD 3.9, which is 4% gold ETF, and HYG or IEF, which are bonds ETFs, they have a 1.2, 1.7 average daily returns. So there is a very large difference in performance, average performance. Nasdaq or Schwab ETF, it's 4 or 5.7 daily return. So definitely equities, they outperform anything else in the market. But gold, it's a very good asset to have. And we can see here, for example, gold has a kurtosis of 5, okay, which is in excess of 3, so it's an asset which has very fat tails. But AGG, BND, this bond ETF, they have kurtosis of 55, 37, which is humongous, even HYG. So they are very much leptokurtosic. They have very large fat tails. So it means that bonds, they are quiet most of the time, but when they sell off big. Big, a lot. And here, for example, we see that QQQ is a very liquid ETF and the kurtosis is 7.5. So the kurtosis parameter of QQQ, it's way smaller than a bond ETF. So there are all sorts of parameters to consider. Yeah, LQD, okay, investment grade corporate bonds. If we compare this with the kurtosis parameter of QQQ or the Russell 1000 ETF growth, we see that the LQD, it has a very large kurtosis parameter. So even though bonds, they are less volatile, when there is a bond market sell-off, it tends to be very large. So there is a lot of fat tail in the distribution of daily returns. So that's basically something in the risk management sphere of things that is important to consider. But we can see here, if we continue here, okay, that the historical VAR 95 for LQD is 0.7%, and the VAR 95 for QQQ is 2.2%. So there is a balance between the two things. Okay, so the drawdown tendentially is larger on equities, but bonds, they are more leptokurtotic, so they have larger fat tails. So that's the main construct of the whole mambo jumbo. And so, as I said, we can theoretically build a portfolio asset allocation, adjust for the VAR levels, the VAR parameters. Yes, we can do it, no problem at all, and it would be very, very interesting to do. So, okay, what is gold daily returns distribution? What is the threshold of the daily returns? And then what are the generalized Pareto distribution of expected shortfall. So we see what is basically the fat tail distribution for what concerns the financial asset drawdown. Okay, so we see that here the density is here for 0% or 0.5%, 1%, 2%. We have fat tails of 3.5%, but the density, it's so that means that the frequency of data is lower, yeah, in a certain sense. So again, the same thing. I'm sure there are different nuances. I have repeated the model, but more or less it gives the same concept. The aggregate bonds ETF, let's take the first chart that we have. We see the threshold here, it's 0.45% in daily returns, which is the 95% threshold of the Gaussian distribution. So it means that the p-value of 0.45%, it's 1.645. If you go in the statistical table, you'll find it. And here, the next chart is basically generalized Pareto distribution that fits the expected shortfall. Okay, so for an expected shortfall between 0 and 0.5%, we have higher density. So there is a lot of higher. There is more data points for this part of the distribution, but if we have an expected shortfall of almost more than 3% or 2%, we see that the bars are very, very little. So there is very few data, few daily return, which have recorded a expected shortfall that exceeds the threshold of 0.45%. That can be interpreted on the positive side and on the negative side as well. Okay, mostly on the positive side, because on the negative side we see that the tail of distribution goes even down to -6%. So these are distribution, these are fitted for positive daily returns. And returns level and returns periods in days. Then we have the threshold level and what is the excess mean return. And these are all sorts of parameters that we can insert into our broader knowledge of the ETFs that we are considering. I don't want to bore you with this stuff because I have more things to show you. And we can see here, okay, the 20 years performance metrics for all assets. What is the correlation of these assets to gold rather than to the S&P 500? Okay, so we start to change what is the reference parameter. It's not the stock market benchmark, but it's gold. So we want to see what is the correlation with gold. And we can see here, which is very, very interesting, how the cumulative total returns in the past 20 years, the Nasdaq QQQ is 1,687%, gold is 689%. Still is better of the SPY or the IVV, which is the iShare ETF tracking gold. And so gold provides very large positive returns, which can be better than equities. And the asset correlation with gold is very minimal, very, very minimal for all. So only silver, it has a significant parameter of 0.7, but all the other ETFs, they have a very small positive correlation coefficient. Some of them, they are very close to zero, no correlation. XLF, XLY, they have negligible negative correlation coefficient. So gold, it's tendentially uncorrelated with equities. Although in the past period we've seen gold rallying with equities, this stuff has worried me because I say, okay, this equity rally is not based on very large liquidity probably, and maybe there is a liquidity event risk on the horizon, and so why investors, they are allocating towards gold. It can be also for geopolitical factors. So there is a lot of liquidity, and investors, the funds, they tend to invest in equity and at the same time they invest into gold. So they protect themselves from some other kind of systemic risk, which can be geopolitical risk, which is a macro factor outside the market. And so that's many things to consider, setting aside the inflation framework. But nevertheless, equities like Nasdaq or S&P 500, even the IWF, the Russell 1000 ETF growth stocks, 1,000% total cumulative return in the past 20 years. Very, very, very large rate of returns. Top of the pop QQQ XLK. And as I said, gold provides north of 689%, and it has a very good Sharpe ratio, 0.5. Even GLD is a positive Sharpe ratio. It's not larger than 1, but still it's positive Sharpe ratio. So it provides better total returns compared to its underlying volatility. Okay, so we have here other parameters which are interesting at the same time, because we have the top 10 league table of ETFs measured on different ratios. So the Sharpe ratio is basically the rate of return of a portfolio, the unit rate of return of a portfolio vis-a-vis in proportion to the standard deviation of the portfolio. And so we see that the asset that at the highest Sharpe ratio are the Nasdaq ETF or the Vanguard ETF, XLK, Tech Sector, Schwab ETF, or the iShare IWF, iShare Russell 1000 Growth ETF. They have the largest Sharpe ratio, and they have the largest average annualized return, 15%, 10%. So these provide the largest annualized return vis-a-vis the underlying volatility standard deviation. While vice versa, we have the other another ratio is here, the Sortino ratio, which is almost a proxy of the Sharpe ratio. And basically, sorry about that for yawning, basically is the annualized return of the portfolio in proportion to the downside risk of the portfolio, okay, which is an expanded measure of the standard deviation, okay. And we see how the league table slightly changes because the Vanguard ETF, from considering the Sortino ratio, it goes down in the league table, and what goes up, it's the iShare Russell 1000 and the Vanguard VUG ETFs. So from considering the Sortino ratio, we see here that provides better returns. It's of course it's the QQQ, the XLK, and we have here a sort of linear progression from the largest return to sort of the smallest. What stands out is the XRP, the ETF, or the... Okay, so the Sortino ratio puts more in order the analyzed rate of returns for these ETFs. What stands out is the staples ETF, XRP, which is an interesting thing to see. Here, okay, the Kalman ratio, return to volatility ratio. So basically, these ratios, they measure the analyzed rate of return in proportion of the peak to trough daily returns, or what is the highest daily return and the lowest drawdown in the series of data that we have. So the peak to trough ratio in proportion of the analyzed return of the assets. And so it's I'm not very familiar with this Kalman ratio. It's something that I had to learn. And here, okay, the return on the return to volatility ratio, it's another measure that basically measures the risk reward of the annualized rate of return of an asset compared to the volatility expressed in what is the standard deviation of returns. It's slightly gives a slightly different parameter, but still we are measuring the annualized rate of return in proportion what is the volatility in a sense. But we see that the performances of the league table changes a little bit. So the top of the table is no more not any longer QQQ, but it's the other Vanguard ETF. So tech stocks or Nasdaq stock, they are not the top of the class when considering the return vol ratio. So lots of interesting parameters. Summary table, best performing asset QQQ, nevertheless in the past 20 years, an average 15.5% annualized return. The most volatile, it's confirms to be silver with the 30.8 annualized volatility, which is very consistent with the conditional volatility parameter that we extrapolated from the modeling of conditional volatility. And gold position, okay, what is the pole position? The gold positioning is gold, it ranks 8 out of 37 for the Sharpe ratio and 16 out of 37 for volatility. So it's middle of the pack for volatility and is in the top 10 for the Sharpe ratio. Okay, so here we have Markov switch regime, volatility regime. Yeah, I'm not interested in that. Okay, let's see and implement what we want to know. Okay. So basically, here we can see that we have measured the momentum strategy and the macro, we have tested the ETFs for the macro factor sensitivities. So basically, we are measuring the annualized rate of return according to the 3-factor or the 5-factor French model for macro factors. What that means that we are including into the beta sensitivities of the financial asset macro factors, which can be inflation or GDP or interest rates, so exogenous factors which are not the volatility or the skewness or the kurtosis. And so we are able to measure what is the momentum strategy returns vis-a-vis the macro factors sensitivities of the assets. And we find interesting results, we find the usual results, which XLK or QQQ, they provide the higher return. We know that these are embedded in the data. They have also the highest Sharpe ratio, or 0.95, 0.91. We don't, okay, here we see that gold also, it has a very 0.85 Sharpe ratio parameter, which is very, very high. And annualized return 12.4%, annualized vol 14.4%, which is better than, it performs better than SPY gold, yeah, and many other ETFs. It performs better than the iShare S&P 500 ETF, so gold performs better than the S&P 500 in 50% of the times, which is very interesting. It performs better than Vanguard total market ETF. So equities are not, they don't always, or quite often, they don't outperform gold. Okay, we see here bonds, the solitary bonds here in the lowest rate of return and annualized volatility. TLT it has been a solid disaster. Long duration bonds, they are a disaster. And we can measure here what is the strength or the rate of return of momentum strategy in terms of allocation. If we have a 1 month short-term horizon or a long-term 1 month or 12 months momentum strategy in portfolio allocation, and what are the ETFs that performs better. So this one, VOX, is the Vanguard communication ETFs, which performs better in a momentum strategy ETFs. So communication performs better in a momentum strategy. Eventually, momentum is something that is communicated in the media. There's momentum in this and that. I have no idea. And the IF, it's the iShare Treasury yield with a duration of 7 to 10 year duration. It performs better in a momentum strategy. What doesn't perform in a momentum strategy, it's actually gold and RQD, investment grade corporate bonds. And we see here that momentum strategy, it has IF, AGG, BND, which are all bonds ETFs, which is interesting, or Vanguard growth ETF. So momentum strategy can be communication ETF or bonds or a bit of growth ETFs. Most of, if not all of these ETFs, they have negative returns in a momentum strategy asset allocation, whether it's 1 month, 3 months, 6 months, or 12 months. And we see that the Sharpe ratio is pretty negligible. Although now it depends on how the code has implemented the momentum strategy. I believe that it can be done better than this. So what are the macro factor sensitivities? So the macro factor sensitivities, they are not something unknown. So we take 4 parameters, which is the dollar index, or it's oil prices, or it's the 5-year treasury yield, or 10-year treasury yield, and what happens to these ETFs. Okay, so we see that the TLT, it has very large parameters for the 10-year treasury yield or the 5-year treasury yield. And those are the sensitivity factors, or the betas. Most of the assets, the ETF that we have considered, their beta sensitivity is towards the 10-year treasury yield. This is pretty normal because the 10-year treasury yield is the risk-free rate probably. It can be used as a risk-free rate, so it's almost natural that it can be considered as the most high beta macro factor sensitivity element when we consider the these ETFs, what is important is that TLT, it has a negative beta coefficient, so basically it means that of course when the 10-year treasury yield performs better, like yield go down, probably ETF, the TLT performs better from a price or net asset value standpoint. So a higher beta component, so higher volatility, it's for all the ETFs that track the equity market, basically, what is mostly higher sensitivity. What is the R squared, so the most covariance, macro factor sensitivity, it's the or the linear regression factor. The R square is the linear regression, it's not the covariance. It, of course, is for the bonds ETF. Okay, we see AGG, all aggregate bonds, all bonds, TLT, they have the highest R square factor. So the linear regression between the macro sensitivities that we have here, 10-year treasury yield, 5-year treasury yield, also with oil price or the dollar index, it's very consistent R square parameter. So there is a linear regression interdependence between these macro factor sensitivities that we have here. We can change it. We could put CPI or PPI or Fed funds. So we can build the table in many different ways. That would be very, very useful, and I'm sure there would be many different results. Okay. Here we have something that we already know. Top 5 sharp ratios, XRK, QQQ, GLD Gold. Very good. Okay. So best momentum combination is the ETFs communication, ETFs, Vanguard communication ETFs on a 3-month horizon, and it provides a 5.7% return. And average factor sensitivities, okay, we can go forward. Okay. Okay, so here we have another table, and as I said, we built the factor sensitivities. We can use different parameters. In this instance, we have the 10-year treasury yield and inflation break-even. So we see that all financial assets, these ETFs that I've been modeling, they are they have a very high beta to the inflation break-even. So we have a macro factor sensitivity when we build a 3-factor, 5-factor portfolio allocation, Fama French 5-factor portfolio allocation. And we utilize macro factor sensitivity regression or parameters. Then we know that, for example, inflation break-even, it has very large beta parameter for XLE, for energy, or for financials, or Vanguard total market ETF, even the iShare Russell 1000 growth ETF. So inflation break-even, it has very exogenous factor sensitivity on these ETFs. In the parameters, they are way larger than the 10-year treasury yield. And if we measure the R square, the R square is a bit smaller. What stands out is the XLE, which is 0.17 R square. So there is a linear regression between energy and inflation measure. Okay, so that's useful when we go deep into the Fama French models, 3-factor, 5-factor, multifactor Fama French model portfolio allocation. Okay, so here, okay. So what we have here, so basically we tried to measure the risk parity portfolio from a risk adjusted return on the basis of the Sharpe ratio, and we have different results, okay, because when we do a portfolio allocation and we want to consider a risk adjusted return, then we are not investing anymore in the QQQ, but we have the Vanguard technology ETF. XRK still stands out as risk adjusted annualized return. Yeah, so we start to utilize more specific measures. So we have risk parity portfolio, we want a risk adjusted return. So we want to adjust our rate of return or our annualized rate of return for the risk or the Sharpe ratio and max drawdown and the volatility. And we see that the Vanguard technology ETF, it performs better than the QQQ ETF, okay, and the XRK, and then what is another asset that provides better risk-adjusted return is the XLC, so the communication services or consumer discretionary ETFs. So we see that the composition, not the composition, but the ranking of the annualized return, it changes, it varies, because we are implementing a risk-adjusted strategy in what is the ranking of the ETF, which is not really a portfolio allocation because I've not assigned any arbitrary virtual amount. It's just a ranking of what is the annualized rate of return from a risk-adjusted standpoint, parameter. And yeah, we have different results. Okay, so we see that when we adjust for risk, then what performs better is the Vanguard technology ETFs. I'm sure if we would have included the QQQ ETF, probably it was top of the class. But what stands out, for example, is that the XLC, the communication services, or consumer discretionary or industrial ETFs, they perform better on a risk-adjusted basis compared to financials. Okay, and real estate is at the bottom of the league table with energy. Okay, so real estate carries a lot of risk and lower returns. So on a risk-adjusted perspective, or from a Sharpe ratio parameter, it's not a good idea to invest in a real estate ETF. I mean, on measuring the past performances of the past 10 or 20 years. Yeah, we have a lot of charts which are very, very nice. We can see what is the Sharpe ratio by sector, or volatility by sector, according to different ETFs. And so the cumulative performances in the past 5 years, so the VGT probably it's the equivalent of the QQQ at this point. And the rolling 1 year performance of the top 3 ETFs, we see we have a negative performance in Q4 2024. And also here we are basically at Q1 of 2025, we are erasing all gains. But what performs better is technology and the communication services. So that's another thing to consider in a theoretical asset allocation. If I have technology, maybe I want to have also communication services, because some tech companies, some tech stocks, they are into communication basket. And we have some very interesting data. So the percentage of positive days, so more than 50% of the time we have positive days, and it's on a measure of 7.2 years of data. So okay, best day, worst day, so what is the max drawdown and the highest daily return. Yeah, very, very interesting. Okay, let's go forward because it's a lot of things. And if you are interested in having any of this material, just drop a comment. Okay, and I'll try to reach you out. Okay, so here we have measured volatility, not volatility, we've measured market liquidity in a different way, probably. Yeah, alternative market liquidity measure. And we are able to see, yeah, because we have raw volumes or the z-score. So we have a different set of parameters to which the time series are interpolated. And so let's say, theoretically liquidity is measured in a different way, although the assets utilized are still the same. So bonds ETF or the S&P 500 ETF. So we are not measuring the money supply. And so basically we manipulate the code in a certain way to see, for example, yeah, that in stress periods, by measuring market liquidity with different parameters, like with the z-score and what are the deviation from the standard normal distribution of market liquidity and stress period, we see that gold performance is still it's higher in stress period than in normal periods. So now it depends of how you basically also work around the data. Would very happily repeat the this experiment with this modeling with the money supply, so that I have a better idea of how gold works with in proportion to money supply and market liquidity. Okay, so we are almost done for today, and yeah, okay, so we have different kind of portfolio structures. We have equal weight tangency. What is the tangency portfolio? What is the risk parity? The minimum variance portfolio and the max diversification portfolio. So for all the 35, 37 ETFs, including gold, we try to apply the most known portfolio structures to see which one works better. And we see here portfolio performances comparison, what is the diversification provides the better annualized return, which is theoretical 10.3% based on past data, and the worst performance, it's this one, 4%, almost 4%. Probably is the minimum variance portfolio, and risk parity also underperforms the tangency portfolio or the equal weight portfolio. So basically what is interesting is to see that diversification, of course, provides better returns when it comes to portfolio allocation. And but on the other side, we see that what is more exposed to maximum drawdown is equal weight or maximum diversification, while minimum variance it's more protected to maximum drawdown downside. While the Sharpe ratio, it's optimized, of course, for the tangency portfolio, which is, Kaplan model, Markowitz efficient frontier. So the tangency portfolio is the optimum Sharpe ratio portfolio construction. Okay, so here we have basically how the portfolio have been constructed, what are the ETFs that have been selected. So we see the equal weight portfolio, we have more allocation on bonds ETFs, and is almost all bonds ETF, IF, high yield. There is no LQD, there is gold spot, and there is also a Russell growth ETF, so small cap growth ETFs. The tangency portfolio, which is very interesting, is composed of only these 5 assets. Very simple. iShare bond ETF, 7 to 10 year duration, QQQ, gold spot, consumer staples, and XV. Forgive me 1 second. XLV. What is XLV? XLV. It's healthcare. Very minimal part into the healthcare sector. Most it's IF and QQQ. That's the tangency portfolio. Okay, risk parity portfolio. Max diversification portfolio is not very diversified. It's just 3 assets. Vanguard total income, total growth, total market, the iShare, S&P. Oh, there is no diversification at all. What kind of allocation is that? Probably I'll have to revise how the code worked out the thing. So max diversification portfolio is not really diversified. Okay, so probably these things is better not to assign it to a machine. You need to probably a proper financial advisor to do this work. Okay. Okay, so the last thing I want to share with you is basically doing the portfolio asset allocation with the risk-adjusted component in the portfolio construction. Okay, so we have a variety of strategies, which is equal weight, the tangency portfolio, minimum value, risk parity, diversification. Then we have some more sophisticated portfolio construction, which is the Black Litterman, the core and satellite. So it's the core stocks versus satellites, asset allocation of satellite sector, factor based. So factor based is basically what are the multifactor based, which can be inflation or break-even inflation or treasury yields or Fed funds, stuff like that. Now I repeat, I'm not an expert, and so I managed to do as much in-depth work as possible, in detail work as possible to start from a simple Markowitz efficient frontier, Kaplan or equal weight or a risk parity portfolio, and then add more and more variables and adjust the annualized return for the risk, so including the Sharpe ratio and all other ratios that we have seen together. So to see how the performance of portfolio changes. Now the max diversification here, we have to take it as an outlier because we're seeing the max diversification, it all invests in 2 assets, so it's not really diversified. What stands out is that the Black Litterman or the factor-based or the core satellite portfolios, on a risk-adjusted basis, they tend to perform, although it's less than 10% vis-a-vis a 20% or 12% annualized volatility. But these are the kind of asset allocation that eventually work better on a risk-adjusted basis. But this is not in absolute terms. What I put into the code is 35 ETFs that I have selected from the most known ETFs, which are these ones you see here. So all the industrial sectors, and then mostly replicate the S&P or the Nasdaq. Some are Vanguard ETFs, which can be iShare emerging market, FTSE emerging markets, or the total market, and then there is iYield, there's bond component, there is gold component. So basically the portfolios, they are optimized according to the Sharpe ratio, the sorting ratio, Kalman ratio, what is the max drawdown, and they are optimized on a risk-adjusted basis, and the portfolio strategies, they are implemented and optimized with the parameters that we have introduced into the code, or that AI has introduced into the code for me. What we can change, for example, is the risk-free rate, or we can change the beta that we are targeting, or we can change, see here, there's 2% risk-free rate. We can try to run the code for a 4% risk-free rate. Let's see. It's not easy because I'll have to change it to 4% everywhere. Okay, bear with me 1 second. Let's try and do this experiment live with you on YouTube. For whoever is watching the video, this so far into the content. Okay, we have 4% here. Okay. 3 months analyzed. Okay, risk-free rate. Change it here. Yeah. Okay. I'm not an expert in coding, so I'm doing a lot of work which is outside my core competencies. Let's see if we have some different results. It will not be so different as I presume. Okay, we'll see in a minute the portfolio allocation, which are beta adjusted. Okay, so here we are. Results are pretty much the same, so nothing changes. Max diversification, but we don't have a very much diversification in that kind of portfolio construction as we have seen up to now. So we see here that the tangency portfolio, they are the best performing portfolio asset allocation for either the Sortino ratio or the Sharpe ratio. So they are risk adjusted for standard deviation or the eventual downside risk. Core satellite portfolio construction also, it has the best second parameter together with risk parity portfolio allocation, which is risk adjust. Okay, so if I make any mistake, I'm not an expert, and forgive me if I make any mistake. These are basically the past performances measured in the past 2 years. Okay, so here we see, okay, we have a table of results. What are the modern strategies vis-a-vis the traditional strategies, which is the hierarchical asset allocation. I have to say I don't know exactly what is that. Okay, so we see here the Black Leaderman, which is a modern strategy, but it comes after, basically, it's built on the Fama French multifactor model of asset allocation. In fact, we see the factor-based, which is the multifactor portfolio asset allocation. These are the modern strategies, and we see what is the Sharpe ratio or the volatility of this asset allocation, and we can confront it with the traditional strategies. The tangency portfolio and the risk parity portfolio, they perform better tendentially. And although this CPPI, it has a very good Sharpe ratio and contained volatility, somewhat contained volatility. So okay, let's see what the results tell us. Equal weight portfolio, it's easy to implement, but it's suboptimal. The key advantages is the Sharpe ratio. The tangency portfolio is optimal for risk-adjusted returns. The key advantages, which is the Sharpe ratio, is optimal, which is natural, of course. The global minimum variance portfolio, it has some sort of decent Sharpe ratio. Risk parity, it's there's an equal risk contribution from each asset, so it's a balanced approach on risk-adjusted basis. Max diversification, it focuses on uncorrelated assets, so they have assets which are negatively correlated. Okay, hierarchical, basically it clusters group of stocks or financial assets, maybe by sector, or it's another another thing that comes from the Fama French portfolio theory. Okay, Black Litterman incorporates investor view the constant proportion portfolio insurance, so it's a dynamic allocation. Okay, so now we know that basically the best thing to do in portfolio allocation, we are learning it from the machine. It's either having a dynamic portfolio allocation when it comes to the modern strategy of portfolio allocation. If we want to use a traditional portfolio construction, we either go for the tangency portfolio or for the risk parity or risk adjust portfolio. That's very interesting. And last but not least, let's see together the risk adjust portfolio. It's beta adjust. Okay, so we adjust portfolio allocation incorporating the beta of the assets. And we see here that the top 5 assets for beta is financials, energy, IWM is the iShare, is the iShare tracking the Russell 2000. Then the W, that's the Vanguard emerging market, and then we have technology. Okay, so the top 5 assets for beta are these 5 ETFs. The bottom beta assets, they are all the bonds ETF, TLT, and gold. Okay, so but that is not negligible, because the beta, it works on the upside and on the downside. But we know that gold, it has an average annualized return of 12%, and having a beta close to 0, it isolates from the market risk. So in a sense, in a practical sense, it's very useful to have gold vis-a-vis an ETF which has a beta of 1.29, which is riskier than the stock market in simple terms. So let's see what performs better. What stands out, of course, is the QQQ, as we have seen all along, or the IVV, which is the iShare tracking the S&P 500. Now, the QQQ stands out as the max Sharpe ratio adjusted for the beta, while the S&P 500, the IVV, is the minimum variance adjusted for the beta. And the gold here stands out as a good Sharpe ratio adjusted for the beta. XLK VTI is the Vanguard total market. Okay, and okay, so we have here the expected return vis-a-vis the volatility strategy adjusted for the beta. So what is the volatility? What is the volatility of the portfolio adjusted for the beta vis-a-vis the return? Okay, so of course what provides the highest return is the max Sharpe portfolio when is beta adjusted, and then what works worst is the equal weight portfolio. Okay, so we've seen different things. On a risk adjusted perspective, the best thing to do is either doing a dynamic asset allocation, so you have an active management of the portfolio, and otherwise, if you want to use traditional portfolio asset allocation on a risk-adjusted perspective, risk-adjusted measure, which is the standard deviation of the analyzed volatility, the traditional portfolio, it's either the tangency portfolio or the risk parity portfolio. Now, if we consider the beta adjusted portfolio, we don't consider anymore a dynamic portfolio asset allocation or a dynamic periodic rebalancing of the portfolio, which you will always have to do, but we just go for a max Sharpe portfolio, okay, or a minimum variance, which would be minimum variance. It's almost similar to the tangency portfolio. Okay, so we are using mostly traditional portfolio asset allocation. What works best is the maximum Sharpe portfolio, and then that means that you would build the portfolio mostly with the tech stock or growth stocks, and probably some bit of gold or the S&P 500, and that's basically that's it. That's all that I can provide for now. I hope you enjoyed the video, and we have seen a lot of things. which are very, very interesting. We can see here, when we go deeper into the details, we see how it's different, when it can be different. That can be very much nuanced, the portfolio asset allocation, if we do a beta adjust portfolio compared to a risk adjust portfolio. And we have modern portfolio asset allocation, which can be a dynamic and a rebalancing portfolio asset allocation, or we have a traditional asset allocation, which is the tangency portfolio or the risk parity portfolio on a risk adjusted basis. So, risk adjust measure. And so, if we are beta adjust, we probably would bid our portfolio for a max Sharpe ratio performance, and eventually we would be allocated to Nasdaq ETF, tech stock ETF, Russell 1000 growth ETF, Vanguard growth ETF, S&P 500 ETF, that kind of stuff. Okay. Well, instead, if we do, okay, let's see here. Let's be very precise. Let's do another thing, and so that we simplify our life. Okay. So, at the end, what happens? A max Sharpe ratio beta adjusts. So the minimum variance portfolio beta adjusts. It has an expected return of 12%, a little bit more than 12%. Okay. Also, risk parity portfolio beta adjusts. It's around 11.5%. Okay. And okay. Yeah, minimum variance or risk parity. Yes, yes. Okay. So max Sharpe ratio. Okay. Minimum variance or risk parity. Okay, yes. Okay. We have 11 and 12%, 12.5% expected return on a beta adjusted measure. Okay. If we do an asset allocation still on a beta adjusted measure, we can have higher return on a max Sharpe ratio portfolio allocation. You can see here what the expected rate of return max Sharpe ratio beta adjust portfolio is 16.3%. Now we want to compare the beta adjust portfolio with the risk parity portfolio. So what we see here is that the annualized return or the expected return on a risk-adjusted basis is a bit lower, and also the Sharpe ratio is a bit less inviting than the beta adjust portfolio. Okay, so this is very, very an interesting comparison between the two things. Okay, and as we saw here, we can utilize a modern strategy of portfolio allocation, which is the constant proportion portfolio insurance. So we have a dynamic allocation between risk and safe assets. So what we can understand, and understanding with you all, is basically on a risk-adjusted measure, if we want to have a similar Sharpe ratio to a portfolio which is beta adjusted, we need to utilize a dynamic portfolio rebalancing on a risk-adjusted basis, so on a annualized vol or a standard volatility or a standard deviation measure. Okay, but if we do a tangency portfolio or a risk parity portfolio, we have lower expected returns. In fact, we see that the tangency portfolio it's 8%, the risk parity portfolio is 6% annualized return when we do it for a risk-adjusted measure. Even the minimum variance portfolio is 4%. So at the end of the day, tendentially what can provide the better risk reward is having a portfolio allocation which is beta adjusted. Okay, so we have to incorporate the beta with the Sharpe ratio, and we can build a portfolio, have a portfolio asset allocation which maximize the expected return. Instead, if we want to have a portfolio asset allocation which is based on a risk-adjusted measure, we need to do periodic rebalancing. So we need to have a dynamic management of risk management of portfolio. and that probably can basically generate asset allocation error, and then it can generate inferior total returns or annualized returns in a sense. So what is optimal is to have a portfolio asset allocation which is beta adjust. So I hope you like the video, and leave a comment, thumbs up for this video, and peace everybody, enjoy your days, and see you soon see you again at Oeconomica.